David is he's a partner at Strategic Government Properties, where he's responsible for development, deal sourcing, and analysis, and managing institutional relationships. He has extensive experience working with institutional and high net worth investors in a variety of asset classes. And most recently, he consulted to Genspring Family Offices, which is a $16 billion multifamily office. During his career, David has started, built, and sold several companies in the consumer products and marketing sector. So he's an entrepreneur. He's a fellow entrepreneur. He began his career at Goldman and serves as the managing director of Chazen Capital Partners, a private investment partnership which provides equity and management support to technology and consumer-oriented businesses. He's a director of the Chazen Institute of International Business at Columbia University in New York, and he's a founding member of the Young Presidents Organization, YPO, Aspen chapter. He has run 21 New York City marathons, which I trust is his biggest accomplishment, and has received his BS from the Wharton School at UPenn and his MBA in finance from Columbia. David, thank you so much for agreeing to talk to AICC and our members today. Let's get you started.
Great. Can you hear me? Raheel, can you hear me?
Yes, David. Yes, I can, and I believe everyone can.
All right. Thank you, everybody. And Raheel, thank you very much for inviting me to be here tonight. Thank you to the American Ismaili Chamber of Commerce for allowing me to have this opportunity. Raheel and I have known each other since 2015, and our connection is indeed through YPO. What I'm going to do tonight is take you through an overview of what Strategic Government Properties is, the niche that we believe that we're exploiting. I will then, after I finish the first part of the presentation, I will pose and answer frequently asked questions based on many of these experiences. And after that, I will go through two examples of properties that one that we own, one that we're under contract for, so you can see our process at work. And at that point, with what's time remaining, Raheel will field other questions that you might have for me. So assuming that everybody, those of you who are watching on the monitor, well, you'll see what's on the monitor. Those of you who are referring to the deck that was sent out earlier, there have been some additions. The page numbers are the same, but there's some additional work in here, including a second page of frequently asked questions. So with that, let me move on to this. First, our mission. At Strategic Government Properties, we deliver consistent, superior, risk-adjusted returns to our partners through our ownership, management, and sale of mission-critical government buildings. That is our mission. Now to our strategy and experience. So in a nutshell, and this applies for every property that we'll own, first, we identify new or newly renovated, cash-flowing, mission-critical government properties. We own 2 FBI buildings. We're interested in the DEA, Department of Defense, et cetera. We then diligence each building to get to a 98% certainty that the tenant will enter into a new lease at the next renewal. So, for example, if we buy it with 8 years remaining on a 10-year term, we enter this with 98% certainty that they will enter into a new 10-year lease at the end of the first term. And I'll get into why that is. In our business, given that our tenant is typically the full faith and credit of the U.S. government, this has the same credit quality as a government bond, yet we provide investment returns far in excess of, say, the 10-year bond. But it is real estate, and we target our annual cash returns between 6 and 8%, and that cash flows immediately because we're buying cash flowing properties. And the IRR upon sale, we estimate to be between 11 and 15%, with an equity multiple of 2x or 3x. While we own the properties, we actively manage them to service the tenant well, and then to create added value at the property. We'll often identify a catalyst for early lease renewal and attempt to achieve early sale. I'll get into that if we have time. We distribute annual returns in excess of 6% to investors, paid quarterly. Our 6% is our hurdle rate, and we distribute everything that we make, but 6% is the hurdle. We pay this quarterly, and plus we distribute the depreciation benefits. We will renegotiate and optimize a new 10-year lease that follows the current lease. That could be anywhere from, depending on how many years are left or remaining in the lease, but let's use A as an example. We figured around the 6-year mark, we will negotiate a new lease. When the new long-term lease is in place at a higher rent, then the building is worth its maximum value. Imagine an FBI building with a new 10-year lease in place. That's when it's at its highest value. That's when we sell. Our experience, we've had between my partner and myself, we've had a 10-year focus on only mission-critical government buildings. Over the years, we've owned 2 million square feet of government property in 13 states. That's 19 buildings total. 14 have been sold to date. In our experience, every property has paid their rent in full and on time every month. Every building has renewed their lease at the end of the term as we advertise, and all have achieved projected returns or better. Now, why do we invest in government properties, and why did I get involved in this business? And it really goes to the third point, which is the mispricing by financial markets. But I'll get to that. First, it's a very large market. The General Service Administration is the government leasing arm. It leases 376 million square feet of space in 9,600 buildings. The GSA is the largest tenant in the United States. The government, the U.S. government, is also the largest owner of property in the United States. And the GSA was formed 60 years ago so that in order that the government didn't have to keep owning properties, they saw it as more beneficial. Would it be possible to mute that user? Jalal, if you're on the phone?
Yes. Yeah. Can everyone please mute themselves?
अरे भाई एक सेकेंड अली आजा
Hello?
खाली 2 मिनट देखना है कि is it worth even?
I think the host can do this.
We're having issues doing muting from here. Can everyone mute themselves, please?
All right, let me push through, if that's okay.
Please, David. Thank you.
All right. So the U.S. government is the largest owner. They set up the property. They set up the GSA to become a lessor, a tenant. I mean, I'm sure some of you have experience with GSA buildings. We have focused on federal, but we also look at state opportunities. All of our buildings are ultimately guaranteed by the full faith and credit of the government. For a federal building,
David, I'm so sorry. You'll need to mute people from your end.
I don't have control. I don't have control. Only the host can do it.
Hello?
Can you make me host?
You are the host. If you move your mouse to the top right audio.
It says that AICC is the host on my dashboard.
You can. Okay. Carry on, David. I guess everyone's put mutes on. Thank you.
No, they haven't.
David?
I'm the presenter.
Yeah, please continue. Please continue,
right.
Yeah?
Okay. Okay, all of our properties are guaranteed the full faith and credit of the underlying government. If it's the federal government, it's the federal government. If it's a state, it's the state government. Our tenants are very sticky. I apologize. I don't know if it's hard for people to hear me, but it's very hard for me to present.
Hey, David. I think it's very difficult to hear with the interruptions. So I think the user is Hamida. So if anybody knows Hamida, if you can text her to mute her phone. Thank you so much.
Beautiful.
David, continue. She's been pulled out. Yeah.
All right. Thank you. Okay. So our tenants are always very sticky. In our world, in the GSA world, let me jump ahead to the mispricing by financial markets. The reason that a building with a lease guaranteed by the full faith and credit of the U.S. government returns so much significantly more than a bond with the exact same credit quality, besides the fact that it's a liquid, is that there is a misperception in the marketplace that the tenant might leave. So you can imagine owning a building that's been highly customized for the FBI. And if the FBI were to leave, and you might be stuck trying to tenant that building with another type of non-security tenant, it would be worth a lot less to that tenant. That absolutely is the case. But the truth is that our tenants don't leave. And that's why we focus on mission-critical buildings. So now I want to get to the statistics that underlie our investment thesis, which is that the tenant is very sticky. So public information is available from the GSA that 96% of all first-term build-to-suit GSA leases, which is what we focus on, renews for a second term. And that's everything. It could be a Social Security building or a post office or any kind of an office building. But in a mission-critical facility, like an FBI building or a Department of Defense building, it's much, much higher. Because our facilities are specialized and purpose-built, it's very, very difficult for our tenant to leave. So I'll just give you an example. In the case of an FBI facility, the FBI has extensive post-9/11 security customization that has to be in every post-9/11 security facility, which includes things like security fencing that can stop a vehicle, some bulletproofing, blast-resistant walls that won't tumble into each other like the Pentagon, and so forth. Our tenants can't leave and go to a building across the street or hold us up and say we're going to threaten to go to the building across the street, because they need these facilities to be purpose-built. And the time to build an FBI, even a simple FBI facility, is about 6 years from the RFP to building. So we know they're not going, and they know they're not going. And typically, what we need to make sure of is that the FBI has a commitment to that area. Because conceivably, and I use the FBI colloquially, I'll use it a lot in our presentation, but this goes for all of the government agencies that we work with, that they're not going anywhere, and it's very important, and it's what we're about. So essentially, we are out there sourcing yield for our investors, and we think the risk reward of our yield is among the best in the country. Because we understand an asset class very well that others don't understand as well. The challenge to our world, and I end this with a quote on this page, the biggest drawback to investing in government assets is the government itself. To describe the GSA as a needy tenant would be an understatement, according to nearly every expert in the space. That's from Jones Lang LaSalle. Working with the GSA or any government is very different than working with other tenants, but it's not that difficult. If you follow the rules, you always get paid. We understand how to follow the rules. Mistakes may have been made in early buildings long before strategic government properties were formed by my partner in his previous incarnation, his previous partnership. But we have the benefit of a lot of experience, and we work very well with the government. Okay, so now a little bit about returns. This is a chart demonstrating the returns of the S&P, which is, of course, equities. Our GSA properties showing a 10% long-term return. We actually believe we will have greater than a 10% long-term return. And then finally, the 10-year T-bond. I ran this graph from 1980, but I can run it back to 1927, and it will look the same. $100 invested in year one in 1980, you'll have $1,586 of T-bonds, $3,000 of GSA, and $4,100 of S&P. But the risk of owning equities, as you can see by the volatility, it is heavily volatile, and if you get in and out and so forth, you might not do as well as this. Obviously, in my portfolio, I own equities, I own GSA, I own other real estate assets. I even own some fixed income. But we think that GSA offers tremendous upside given the low risk. So the investment criteria, which I've already talked about a little bit for what we do, is we look for new or newly renovated buildings that are built for the high-tech needs of government agencies. And when the government builds, they're really looking for a useful life of 40 years. We look for state-of-the-art buildings. Many of our buildings are LEED Gold or LEED Silver. And the things I talked about already with location, setbacks, fencing, bulletproofing are usually part of the buildings. Now, we focus on mid-sized buildings between $6 and $15 million of 15 to 50,000 square feet. The reason for that is we're trying to achieve a minimum of 6% cash on cash in our buildings. We really look for 7 and above. That's not available in larger facilities. In larger facilities, we're in competition with the REITs in our space, and these things will trade at a much lower cap rate. They'll trade at a 5 cap. We'd be looking at cash on cash returns, at 5% or far less. And there are buyers there, but not for the smaller buildings. And that's something that we focus on. But it's the exact same credit. We're looking for single-tenant, build-to-suit facilities. We look for 98% certainty of lease renewal, and we'll talk about that. We look for mission-critical buildings that we believe are not going away. And they're mission-critical for either the federal or the state governments. Now, due diligence is very important to what we are. And the primary question that we're trying to answer is, will the tenant renew? So I'm going to start with the statistical diligence, which I've already talked about a little bit, which is that 96%, automatically 96% of first-term built-to-suit GSA leases renew. But because we focus on the security part of GSA, we know that our renewal rate is much higher. Now, in our experience, we have never not had a release. We have a 100% rate, and that's not really bragging. It's what it should be. And we call our expectation 98%. So the general diligence that we'll do on a building is like any of you who've ever owned or bought real estate would be, which is a physical inspection. Especially we're looking to see what their investment is. So if they've put millions of dollars into the building after the build, and they typically have, they have a financial incentive not to go. The government is the government, but they still operate, in our experience, in a fiscally logical and responsible way. We'll naturally meet with the tenant and make sure that they're happy. Now, the federal government's a little bit different. The tenant in the building might be the FBI, but the GSA is the person who pays our rent. So in a way, we serve two masters. And we need to keep the GSA happy, and we need to keep the FBI or the Department of Defense or whoever it is in that building happy as well. And we know all about how to do that. So the location analysis, is the location strategic? And I'll give you an example. It's going to come up in our example later. We own the FBI facility in Reno, Nevada. There are two major FBI facilities in Nevada. One is in Las Vegas. One is in Reno. Reno serves Reno and hundreds of thousands of square miles of northern Nevada. Las Vegas is 8 hours away, and they need two large facilities. Reno has plenty of work. So one of the things we know in our tenant interview is how busy they are with all the things that they do in Reno. Not only is Reno a growing city, but of course, Reno has big city problems like crime. They also have issues with immigration. They also have Indian reservations, which is part of the purview of the FBI. They have bikers. They have plenty to do, and we're very confident that Reno is a strategic location for the FBI. The agency analysis is the tenant agency supported by the government long term. But we feel very strongly that even if our president felt that the FBI wasn't as important as it has been in the past, that the FBI facility in Reno, Nevada is quite safe. And I would buy that any day of the week, including today. The credit analysis, who's the credit guarantor? In the case of the GSA, and the GSA would represent Department of Defense, Department of Homeland, many other departments, all the federal departments, it's the federal government. Sometimes it's the state, if it's a state building. Now, we have a diligence that we call government diligence, which is very important to what we do. In some cases, we need to hire consultants who have extensive contacts. Now, we have extensive contacts with the consultants, and we've developed very good relationships, and we have good pathways to reliable answers. And I'm going to explain government diligence in two levels. Level one, we'll reach out to the staffs of the relevant government officials to find the information we seek regarding our targeted facility. And I'll talk about that when I get to our state example, and you'll understand what we do very well. Level two, if necessary, we use specialist consulting firms. You can call them lobbying firms who have very senior government contacts. So we were looking at a big facility for the Defense Intelligence Agency, which we ultimately didn't go forward with. And in that case, we needed to go to the generals and to find out what was going on with this. So we were hiring a lobbying firm, and we were using an ex-Department of the Secretary of Defense was the person. The former Secretary of Defense would be our point person to get us this information, and we'll do that when we need to. It's expensive information, but it's reliable. And that's been our experience, that it is reliable. Our current portfolio represents 4 buildings. The Military Entrance Processing Station in Omaha, Nebraska, which is Department of Defense. And the FBI Savannah, that's the FBI building in Savannah, Georgia. The FBI building in Reno, which I alluded to. And something called HIDTA, which is the High Intensity Drug Trafficking Task Force building in Georgia, which is the HIDTA agency, which is a federal agency. Our buildings average, as you can see, 27,909 square feet. We bought them at an average cap rate of 7.5. We try to stay north of 7. Our purchase prices have been $6.6 million. We haven't bought that many. We've been very careful with the buildings that we've bought. You can see our price per square foot, for those of you who have real estate experience, is high. That's the nature of what we do. And we expect our average cash flow in these buildings to be 7.7% per year over the hold period. And we expect our IRR to be 14.6, which is a little on the high side for what we typically advertise, but that's because the FBI Reno is a special building, and we expect that building to be worth more over time. I probably won't get into that today. It's just, this is a quick look at the buildings that we own and what they do. I'm going to go through this page. You all have access to it. This is a much larger track record. I'm now on page 10 of the buildings that my partner owned previous to our partnership when he worked for, when he's the chief operating officer for another investment partnership, and all the buildings that they owned. My partner, Phil Auerbach, has had experience with some of the largest GSA facilities in the country, so we have strong institutional experience. You see, he had buildings of 339,000 square feet. So we have an institutional approach to small buildings. And in these buildings, as I mentioned, I've already talked about our returns, so I won't spend any more time on this. And as you can see, the newer buildings are at the bottom. They haven't been sold yet. And you can see who the buyers have been. The GOV REIT, the Easterly REIT, that's the only 2 REITs in our space. And then there's some other private buyers, Sovereign Wealth Fund, and so forth. There are buyers out there for what we do. The investor terms, we have a minimum hurdle of 6% to our investors that we have to make before we can share in the profits. Above a 6, We share 80% to the investors and 20% to us. A little bit about our background. My partner Phil Auerbach has pretty much spent his career in real estate, and he started in investment banking at Donaldson, Lufkin, Jenrette in New York. He went to Colgate and has an MBA from Emory. You already heard my background, and I am an entrepreneur in my past. And I noticed by looking at your website how many entrepreneurs are in your world. So I think we have things in common there. And as an entrepreneur, I really find this to be very much like entrepreneurial pursuits that I have done in the past. I think there is a terrific business proposition that we can exploit for our investors' benefit for the long run. And so the business premise is very sound. I wouldn't have gone into it if I didn't believe that. And it's proven to be the case. Now I'll get to the frequently asked questions. So there are about 10 or 11 questions. Then I'll move on, if it's okay, to try and be sensitive to the time. Raheel, if you want to stop me or speed me at any time, just tell me. The greatest risk in investing in what we do is that the government will not renew their lease. I've already spent a lot of time talking about that, so I won't spend any more time on that right now. Does the government always make its rent payments on time? Yes, we get our checks, at 12:15 a.m. Through the Federal Reserve by wire. We never have to worry about our tenant not paying. We never have to worry about re-tenanting a building. It's not part of our business model. It certainly is part of our business analysis. And so we know what we would do if the government were to leave. But you're investing in us. We'll show you the results of that analysis, but you're investing in us because because we've proven to you that the government will stay. We have never heard of the GSA defaulting on a lease or not making a payment that they were obligated to make. In the government shutdown in 2013, every building that we owned received the rent and payments on time. Every employee in our buildings got their paychecks on time because we were at a security level that was not touched by the government shutdown. We have been asked in the past, what happens in an inflationary environment? This is a bit of a complicated question in that I'll just very quickly explain what government leases typically look like. Typically, government leases are flat for the lease term. So there are no escalations in the government lease. There are, however, escalations in the expense portion of the lease. So we have an obligation to pay those expenses. These are not triple net leases. So we never we're in no risk in an inflationary environment. For example, if the price of energy goes up, we're covered by that. The government covers us there. But on what's known as the base portion of the lease, it doesn't go up. So when you look at the Excel files that we share in every one of our presentations, you can see a kind of a flat, not a completely flat, but a mostly flat net operating income for each year or top line rent for each year. Because sometimes there's some technical reasons. Sometimes we will improve our expense side and we'll make a little bit more money along the way. But typically there are no escalations. So that means you're getting about the same money each year. So what happens in an inflationary environment? We've done extensive work on this. But I just captured one example to say that in an inflationary environment of 4%, which has never happened over a 20-year period, there have been inflation shocks. We've all felt them. But typically 2 to 2.5 is a fair number to use. But even in a 4% inflation rate, we believe we would catch 66% of the upside, because while some of those payments would start to look bad, some of those annual payments would start to look bad by inflation, you have to think about when would the inflation kick in year 1 or year 7. Further, and then because the building will be worth more in an inflationary environment, you pick it up on the asset. So we believe that even in a very high inflation environment, we have covered at least 2/3 of the inflationary of inflation in the building. In a lower inflation environment, we think we're safe, or commensurately safer. Our GSA rent payment subject to the government budgeting allocation process. Very important. So Donald Trump, not to name names, any president might say, well, you know, I'm less interested in funding this or that. The GSA has the right to fund outside of allocation, or else nobody would do business with them. So all of our leases are not subject to allocation. No matter what happens in the government, this is that part of the budget that can't be touched. Moving on, can we compare government buildings to other classes of real estate? We think of our government real estate investing as having bond-like risk with real estate upside. So for those of you who are following along on paper, these are all new frequently asked questions that you don't have in front of you. So I'll read those questions. Bond-like risk with real estate upside. Other classes of real estate like multifamily, hotel, office, and all the rest offer different return scenarios based on their individual characteristics. All of you, I'm sure, invest in real estate, or many of you do, and it might have the upside beyond what we are. It always varies by the asset, so it's difficult to compare a class. One thing we can say generally, though, is that all of the asset classes have greater risk than government properties, than the government properties that we invest in, and that's every single one of them. Sometimes your buildings seem expensive compared to local comps, and that is the case. So strategic government properties, especially our highly secure properties, are often the most expensive building on the block. And that is the case. It's the nature of our asset. So the comps that are more relevant for us are, what does it cost to build a similar building in another state? What did the government pay to build that building in another state? And by the way, these are build to suit. So the FBI is involved every step of the way in building their facility, but it's with an outside contractor. And they're building them in other states, and we can see that. It's all public information. So that's a very relevant comp, and the replacement cost is another very relevant comp. And that's what we look at. Why do we focus on small to mid-sized buildings? I've already described that. We have an institutional approach, but we focus on buildings that are really too small for the larger institutions to focus on. They're happy ultimately to buy them from us, but not to buy them from individuals. What depreciation and tax benefits can I expect? It varies by building, and we can ask us about each individual building that we're doing. We will use compartmentalized depreciation, which is a faster schedule of depreciation when appropriate. Generally, though, for most taxable investors, we expect our properties to provide about 100 basis points of tax shelter versus a fully taxable equivalent. So our 6% would be the same as a 7% government bond, for example. Or looking at a 2% government bond, if we're cash flowing 7%, then we're really like 8%, or a pickup of 600 points. What is our exit strategy? Our strategy is to sell our buildings after the negotiation and implementation of a new long-term lease. As I've described, it's the point of greatest value. Our buyers have been the two REITs in the space, insurance companies, and others. The possibility also exists as well to create our own REIT, which could then be sold to another buyer, and to provide investors with a liquidity option. The good reason to sell to these, when we can sell to these REITs, they can and do buy at cap rates that are lower than the prevailing cap rate. At this point, I'm going to quickly move through two case studies. One is one example. All right, so let me quickly, I've mentioned the FBI Reno, and it's all in here. The FBI Reno is a building that we like very much. The reason it's special is because we are warehousing some free space in that building that the FBI is waiting to get the funding to take. When they take that part of the building, our NOI will go up considerably, but it's good already. I've already described how we did our diligence for the FBI. So I'll just quickly move to a state building, and then I'm going to move to Q&A. We are looking at a building right now. We're under contract for it. This is not a solicitation for your group, but it is very fresh, and this is a state deal. And this is a technology center for the North Carolina Department of Transportation. So this is their technology hub for their building. This is a $4.8 billion agency, and this is also backed by the full faith and credit of North Carolina, which is rated AAA. And for those of you who are involved with other ratings, you'll know that there are no AAA. There are only 2 AAA companies in the United States. So AAA is very special. Now, the only thing worth noting here that's special in the limited time is what we did for diligence. And what we did for diligence is we hired a recently departed senior government official. He worked for the governor, who is very familiar with the Department of Transportation. He had actually negotiated this particular lease. He knew the building very well. He was able to speak extensively to senior members of the government, of the governor's office, the North Carolina Department of Transportation, and we have very, very good visibility on this building. And they are not going to leave this facility at the end of this lease term. They have, A, they like it, B, it has parking, C, they have a huge investment in it. In order for them to leave, they would have to build another technology center and have complete redundancy in order before they could turn this one off. It's not going to happen. We've gotten to that 98% assurance level on this building. And with that, I will end my presentation, and I'm happy to open it up to Q&A.
Thank you so much, David. That is very appreciated. Thanks. So there are quite a few questions that have actually come in from the audience, so let me kick it off. So the first one is, what is the maintenance percentage on collected rent?
I'm not in this meeting. I'm not going to go into the how the buildings operate. I'm not keeping that from you. I'll happily go into that anytime with the people of how the government buildings work, and that's for 2 reasons. A, government buildings work differently than other buildings, and B, my partner Phil is much more versed in all of our expenses, and I prefer he answer those questions.
Sure. So can you talk a little bit more about the capital structure of your typical holdings, and what kind of assumptions go into calculating your NOIs or cap rates?
Sure. That might help. I will open a slide right here. Our investment summary, this is for the current building in North Carolina, which some of you can see, and all of you have. It's page 30, or maybe page 29 in some of your books. The going-in cap rate of this building is 7.75%, and we think our selling cap rate will be 6.95%. Now, our cap rate, the way we analyze cap rates for the exit, is that we will use the prevailing cap rate for government security buildings at the time of purchase. So it's very typical that most of our buildings these days have a cap rate of about 6.5%, but that's federal. This is a state building, and we think 6.95 is a fair cap rate for this building. Now, many times our investors have said, well, David, maybe I don't feel the same way about cap rates 7 years out as you do. And if that's the case, we'll happily put any cap rate you like into our model and run that for you and show you what our returns, those returns would be. Typically for our building, we typically take on 65% loan to value and typically an amortization schedule of 25 years. In the case of this particular building, you can see that the purchase price is 7, but the purchase plus soft cost is 7.9. There's more than soft costs involved. There's some capital expenditures, some TIs that we'll be putting in this building. It's usually not that much, but we disclose everything that we do in our sources and uses, and we're completely transparent with all of our costs. Raheel, does that answer the question?
It does. Thanks. So let me quickly move on to the next one. What are some of the conditions under which your mission-critical buildings may not be renewed by the GSA?
In the case of the, I'll give you the buildings that we own, and I'll quickly tell you what we own and how that might happen. In the case of the MEPS Omaha, this is a military entrance processing command station. This is where recruits go to be interviewed and tested, both medically, psychologically, and for aptitude to what service they'll go into. They literally walk into the building as a recruit, and they could have been recruited anywhere, and they walk out of there in the National Guard or the Air Force or the Marines. And they go through a U. It's a highly specialized building that's built so they can go from station to station in a big U. And when they will take the oath in a building in a room with flags and sign a contract that they've joined the military when they're done. Also, some people wash out. That building is in a region that deals with hundreds of square miles, and the government puts these in very strategically. Plus, it's a brand new building. So there are a few old MEPS facilities. Those would be the first to close. So this building was built for a 40-year useful life. There are some old buildings that might become superseded by this new building. But we are one of the new buildings. So we don't think we're in any danger of being made redundant. And by the way, if that were to happen, it would happen 20 or 30 years in the future, certainly not in this first renewal period. So we think we're safe. In the FBI Reno, I've already described the importance of the FBI in Reno. There are a couple of small satellite offices in Carson City, in Lake Tahoe, and literally 2 or 3 man offices. We wouldn't be buying those. Those are non-secure offices in an office building. But if they were to do any consolidation, it would be into either Reno or Nevada. We have extensive contacts at the FBI. Our own diligence, makes us very confident of the importance of Reno. Plus, our discussions with the FBI make us very confident that the FBI is not going to leave this facility. HIDA Atlanta is financed by the Office of the President. This is you might call it the Office of the Drug Czar, which they call it from time to time. Our building, HIDA Atlanta, is a task force building. And what they do in our building is they don't do any. There are many aspects of the government's policy on narcotics, including treatment. This is not about treatment. This is about interdiction. So our building is about task forces that intercept drug seizures, drug cartels. Our building, I don't have the facts in front of me, but the seizures from HIDA Atlanta over the years have been, something like 10x their operating costs. So I'll make up a number. It costs $1 million for them to run the building to run the building every year with all of their staff and all of their expenses and all of their rent, and they bring $10 million into the government. But it's really more like, probably $10 million to $100 million. They are a huge revenue driver for the government, and that's not just cars and houses. That's cash as well. And we're not counting drug seizures as money. We're only counting money as money. So this is a revenue driver for the government. In our extensive due diligence, they enjoy having this type of facility anywhere they can have it, and it's been on a growth mode. And they've been in business for over 20 years. They moved from a building that they outgrew into this building where they had stayed for the previous 20 years. So we feel very confident that this building isn't going anywhere. And I won't go into Savannah because it'll sound a lot like Reno. So that's typically what our risk is. Our risk is that they will get out of being in call it the Department of Defense business in that area. They'll want to get out of the FBI business in that area. They can't move to another building because there is no other building that they will qualify. So typically, that's the risk, that they would get out of business completely and say, we're consolidating out of that facility. And that's one of the most important things that we're trying to diligence. And by the way, you can see we haven't bought that many buildings. We're very selective. We look at a lot of pitches, and we only swing at the good ones. Does that answer the question?
It does. Thank you very much. So let's do the final question before we can wrap up. Given what you're seeing in this industry, David, and your focus on the small to mid-sized government assets, how do you see the space evolve in terms of opportunity and risks over the next 3 to 5 years?
At our industry trade conference, it's a pretty small trade conference. About 100 people show up. in Washington, D.C. Everybody was we were getting statistics from our organization, and the federal building, the transactions in the federal space were down by 66% in 2016. Federal buildings are not being built at the pace that they've been built at in the past. So there are fewer buildings with at this stage right now, and certainly for the next 2 or 3 years, we think there will be fewer federal new buildings coming on stream. Our business, though, is not, and so the federal buildings that we get, and by the way, we're looking at many federal opportunities right now. These are buildings that are being renovated, so they're not new per se, but they're newly renovated, and these transactions do come up, but we definitely see fewer than before. But we are also in the state space, and we're very comfortable operating in states that have very high credit, and I think there are about, this is off the top of my head, 15 to 20 states with AAA credit, where we're focusing our efforts right now. And we are seeing a lot of opportunity in the states. So that's, in general, then, to answer your question, new buildings at the federal level have gone down over the last few years, but we still see opportunities for buildings that are being renovated, and we see a lot of opportunity at the state level. We will probably see more from us as state buildings over the next few years.
Okay. With that, thank you very, very much, David, for agreeing to talk to our AICC members today. Sorry.
I do see. I got a message, and 2 people asked a question. What's the minimum investment? Typically $100,000. About the fee. That is not a correct fee. At least it says somebody put a fee number that's the 26%. That's not accurate. Happy to take any questions about our fees afterwards. And our equity in our holdings is typically we put in a minimum of we usually put in 10% into each deal. Typically no more and typically not less. So with that. I think I've answered all the questions so far.
Okay. Thank you, David. And in response to one of the questions, just so you know, everyone on the call, this call is not designed to be an investment presentation of any sort. It is truly an educational call that David was kind enough to give us on the space. Our hope as a board of AICC is that in the coming months, we are able to bring David back on with a deal that our members can review as well for their own investment purposes. So we will get into a little bit more detail on deal-specific information at that time. David, thank you so very much again for talking to us. Everyone, a recording of this call, including the first 10 minutes of chaos, will be available, and we'll post it on the AICC page in the coming days. A reminder that we do have another call that we have scheduled for next Wednesday, for which you will get an email invite tomorrow morning, and that call will be focused on multifamily housing units, so apartment units. Also a fund that's going to be presenting us on the opportunities in that space on June 7th. With that, thank you so much, everyone, and Yale Madat.
Thank you, everyone.